Hey, everybody. It is the 2nd of January 2026, and this is the first episode of Let's Get Jeffed Up for 2026. So I'm excited to continue to do this, to have this be an ongoing endeavor with Let's Get Jeffed Up. So today, what I wanted to do, I wanted to talk about kind of what we saw in 2025, where we're going to be in 2026, and answer questions about the market and rates and all that stuff. So let's get started on kind of 2025. I'm going to use some props here to help me a little bit. So 2025, we started, obviously rates were higher, and rates are great now. So let's see. So we're going to look, mortgage rates at this time last year were right around 7%, 7.25%. So we had a lot of people that were not super excited about being in the marketplace because of where mortgage rates were, but we still were having a little bit of activity. So this year, we are currently sitting on, depending on the loan type, we are sitting where conventional loans are probably around 6 1/8, 6 1/4. FHA government loans, VA loans, we are right around that 5.5, 5 1/4, or 5.5, 5.625 range. So we are way better, probably a point better than where we were at this time last year. So what does that mean, and why did that happen? So we had a lot of stuff that was going on with the Federal Reserve, and that caused a lot of people to be worried about the marketplace, see where we were. But the Federal Reserve, what they do does not necessarily impact mortgage rates directly. It more impacts rates that are on a short-term basis. So you're talking like home equity lines of credit, auto loans, RV loans, those sorts of things. But there is a trickle-down effect, because when they do cut rates, it affects the 10-year Treasury note. The Treasury note, the 10-year Treasury note, is what is used to manage our debt in America. So how it works is we will sell 10-year Treasury notes, and then we use that money to pay our bills. So that's how we take care of our debts. So with that being the case, as the 10-year Treasury note has come down, which is an effect of what happens when the Federal Reserve lowers their interest rate, we get in great shape. So the 10-year Treasury last year got as high as 4.7, and right now we're sitting. Right now, today, I'll take a look. We are exactly at 4.1887. So we're down quite a bit from where we were when we started the year. So there's a huge correlation between what is called a mortgage spread, the Treasury rate, and the rates that you will see on the street. So the Treasury rate, when we were up near 7, 7 1/4, that spread for mortgage rates was about anywhere from 2.75 to 3%. So you would take the Treasury note rate, which was back at 4.7, 4.6, and you would add 2.75%, and that is how you would get your mortgage rate on the street. Well, right now, that number has shrunk quite a bit. It shrunk from that 2.75 to 3, and we're now sitting at about anywhere from 2, 2 1/4 on your mortgage spread. So even though we haven't seen as much of a reduction in the 10-year Treasury from 4.6, 4.7 to that 4.18, we were down as low as 4.11 recently. That's why rates are much better than they were at the start of the year, because that mortgage spread has improved so much that you will not have as big of a spread, and so you won't have as high of a rate. Anybody, if you have any questions, go ahead and throw those in the chat. I'll try and answer them as they go. So the other thing that has happened is we're seeing a little bit of an increase in inventory. So as inventory increases, we get a little bit more of what's called a buyer's market. So when you look at the real estate market, there is some technical schools of thought. Anything where your amount of time on market or the amount of inventory you have, the lifespan of that inventory is 4.6 months or longer, it's considered to be a buyer's market. At 4.6, we are a balanced market. At 4.6 months or less, we are a seller's market. So right now, we're in much more of a balanced to buyer's market, which means that you can go out and get more things like incentives or seller concessions. So a seller concession is something that is used to help the buyer actually consummate that transaction with less money out of their pocket. So with that being the case, let's talk about kind of how that works. So let's say you've got a house and you are going to offer $500,000 on a conventional loan, depending on what your down payment is, depends on how much concession you can get. So with that, on a conventional loan, if you're only putting the minimum down, which is 3%, you can only get 3% concessions. On an FHA loan, if you put down 3.5%, you can get 6% concessions. So there's some reasons why FHA can be a loan that would be more advantageous if you have a little or amount down. If you get to 10% down, then the conventional loan will also allow you for 6% in concession. So $500,000 loan, let's go 3% concessions. That's $15,000 that you can use towards your closing costs and to buy your rate down to a lower rate. The thing that cannot be used for, it cannot be used for part of your down payment. In a mortgage loan, there is what's called a statutory requirement for down payment, which means you have to come up with your own funds or gifts from somebody who is a family member to be able to create your own down payment. So that 3 or 3.5%. So let's talk about the mortgage spreads again, like your 5. That's a tough one. So the mortgage spreads, I'm gonna actually use my buddy ChatGPT and say, hold on. Let's see what I'm not very good with explaining things down. So here's what we're going to do. All right. I'm just going to read what old ChatGPT said. So there's a very serious, very boring kid named the 10-year treasury. He is the safest kid on the playground. Everyone trusts him. He never steals snacks because he is so safe. When you lend him money, he doesn't have to say pretty please or offer much candy back. He pays a very small reward. Now enter mortgage loans. Mortgages are like lending your bike to the kid who promises to give it back over 30 years. Most kids are good, but some fall, some forget, some move away. That means lending a bike is riskier than lending lunch money to the super boring kid. Because the mortgages are riskier, lenders say, if I'm going to lend you my bike, I want extra candy. The extra candy is called the spread. So here's the simple rule. The 10-year treasury is the safe baseline. The mortgage rate sits on top of it, and the spread is the extra interest that lenders charge because mortgages have risk, paperwork, and servicing, and more human interaction involved. Hopefully that made sense. I've been doing this too long to be super simple, and my wife is always good about telling me, hey, that sounded great, but nobody understands what in the hell you're saying, so bring it down to a different level. So that's why I love using ChatGPT to help me bring that down to a level. So let's talk a little bit about inventory. So inventory in the market has come up quite a bit. We've got a lot of inventory, and a lot of that here happens to be in the new construction vein. I had a buddy of mine help me out. Right now, for new construction that is completed or under construction in the Ada and Canyon County area, we have 1,527 listings that are out there that are new construction, which means completed or under construction. So when we talk about inventory that goes up, that means that we, as buyers, get more opportunity when there's more inventory, because we talked about that a little bit before. where we look at the how many months of inventory lean towards seller's market, balanced market, or buyer's market. And we are right at that 4.855 month place where we're not 100% buyer's market. We're closer to balanced. But even though we're closer to balance, everybody is willing to help buyers get in right now. So with rates being lower right now, with inventory being higher right now, that means that it's a great time to go out, have your agents that are super competent help you negotiate a deal that will make owning a home much easier for you with a much lower rate. I'm doing a couple deals right now. I've got 3 of them currently where we are doing a purchase of a new construction. They're taking large concessions, 6% concessions. So we're close to about 30 grand on these. Those buyers are all getting a base rate of 5.625, but then we are doing what's called a 3-2-1 buy down. So the best way I can describe a 3-2-1 buy down to you is that you use the seller's money to pay a portion of your mortgage payment for the first 3 years. It starts as a large portion of the payment in the first year. It graduates a little bit less in the second year. It graduates a little bit less in the third year. And then the fourth year and moving forward, your payment is at the base payment. But that first year payment is based, instead of 5.625, on 2.625. That second year payment goes to 3.625. The third year payment goes to 4.625. So what that does is allows you to kind of grow your way into that final payment, or if rates come down lower than what that base payment is, you can refinance that loan. And then any funds that are left over in the account that helps to make that payment with you from the builder, those account funds come back to you and come back against your principal owed. So in other words, they pay down part of your loan so that you don't ever lose any of those funds. It's a really cool program, and it allows people to come in and get into payments that are really, really aggressive for a new construction purchase. So I'm gonna grab. I sent one to one of my clients, so I'm not going to say who it is, but the purchase price was $429,900. They're doing a 3.5% down, which means their loan amount is going to be $422,200. Their base rate is 5.625. So their payment normally would be $2,817. But on the first year, that payment's going to be $2,082. On the second year, that payment's going to be $2,312. And on the third year, that payment's going to be $2,557. So that shows you how you can grow your way into a payment. When these are good for strategy, is you have somebody who has just come out of college and they're getting a job and they know they're going to have increases coming their way, pay increases. So they can start with a lower payment. Hopefully that increase in pay will keep up and make them not worry about that bump up in the payment those years coming forward. Or if you have some people that are maybe somebody is in school, somebody is working, they can afford the payment that is there, and they know that that person who is in school is going to graduate and get a job, and they're going to add income to that family. I never want to use this as something where you just are trying to get a lower payment, because that's not the point of this. The point of this is to grow your way in to that base payment. You always qualify on the base payment, or that payment that will be there after the 4 years. If you're not going to want to do that, then there's some really good things now. And I know they get a bad rap, but right now, let's talk a little bit about adjustable rate mortgages. So adjustable rate mortgages right now have been, for a long time, adjustable rates didn't make any sense at all. You couldn't get a low enough rate on that adjustable rate to make it make sense. You would be much better off going fixed rate. Right now on government loans, though, we have some 5-1 ARMs and 7-1 ARMs that are down in the 4s. So you could get a loan with a rate in the 4s, and that would be a fixed rate for either 5 or 7 years. When that's applicable would be when you have somebody who you know is only going to be here short term. So I would think about like maybe somebody who's moved here to work on the Micron project, and they know that project is going to last for 4 years so they can get a 7-year term that is fixed at a much lower rate than a 30-year fixed. And it helps them to actually pay down more principal and less interest expense during that time frame. So there are always ways to think about how you can use strategy, and that strategy can help you make smart financial decisions. If there are people who know, again, like they're going to want to move within the first 4 years because they're going to either have a job that goes somewhere else, or they're going to maybe have kids and need to move up. Again, if you know that your exit strategy is within the fixed period of an ARM, it can make a lot of sense because you're going to pay a lot less in interest. Anybody have anything out there that is they've been thinking about? One question, I'm open to whatever people have out there to ask. Or has anybody been thinking about buying a home, but they're scared? They're not super excited about the process. I just had one. I just had one that I closed, and they came to me, and the gentleman had a credit score that was under 600. I'll get to that in just a second, Scott. Great question. He had a credit score that was under 600, and he was worried that he wouldn't A, qualify, and B, that his rate was not going to be good. Well, we have some of our investors, because I'm a broker, I don't just have to do one thing. I can go to many different investors, and some of our investors have an appetite for those lower score borrowers. So we were able to get him done, still got a rate of 5.625 on his loan, even though his score was sub 600. So don't let your situation scare you off. Always, always, always reach out to myself or another preferred lender, somebody you trust, and let them walk you through what that looks like, because you don't know what you don't know. We always talk about that. You don't know what you don't know. So it's better to go out and ask that question and have somebody who is a professional help you with what actually is out there, what could help you. Scott, Scott asked, how about house hacking? You buy a house and you get a renter or two. That's great. But one of the ones I really like is when you do a duplex. So let's say you're a young couple, no kids. You're not worried about the ability to have just your own single family house. Buy a duplex. And I'll tell you why this is so smart. So say you buy a duplex, use a FHA loan, you do it as a primary residence. You still get it under a 6% rate. You get to count, number one, the rent on the other side of that duplex towards qualifying at time of buying the duplex. So even though you don't have it rented yet, you can do what's called a rental schedule. You get to use that rent to qualify. And then when you decide it's time to move on and go single family house, you own a duplex. So you get twice the amount of rents. So let's say each side rents for $1,500 a side. Now you've got $3,000 a month in rent to help offset that payment on that. So house hacking is great. If anybody ever wanted to get into a deeper conversation about house hacking, shoot me a DM and we can have that conversation, create an appointment and let you know how that works. Anybody else with any questions out there? Anybody who has anything exciting that they want to talk about? How was everybody's New Year? I know we just chilled out. We stayed home with the dogs and the cat and just kind of hung out and enjoyed ourselves. We weren't crazy at all. And then we had a nice birthday party for a friend last night. We really enjoyed that. So our New Year so far has been slower moving, which we're just getting ready to ramp up. Let's talk a little bit about 2026, where I think the market's going to go 2026. Talking to, I have a guy I follow. If you're watching, write this name down, Logan Mohtashami, Mohtashami. Logan Mohtashami. He is the lead analyst for Housing Wire, and I follow him. He is super smart. He is actually going to be here next Friday. Homes of Idaho is having a success summit. This is unsolicited. They didn't ask me to do this, but Homes of Idaho will be having them reach out to either Cassie or Colby at Homes of Idaho. Get a ticket to that. You can go see Logan live. But he does a prediction every year. And his prediction for rates this year has been on the high end 6.75, on the low end 5.75, if the 10-year Treasury stays between a range of 4.6 and 3.8. So I believe that we're going to stay lower. I think that we're going to stay in that 6.25 to 5.75 range here in the Valley. And I think that we're going to see our market heat up quite a bit. We've got a bunch of inventory. We talked about that, 1,527 new construction homes right now, either under construction or ready to go. And we're starting to see some of the inventory that was kind of locked up with lower interest rates come out. People have been in their homes long enough that they're starting to have events in their lives that are not allowing them to just sit there because their rate's low. So that's also unlocking some inventory. So with us being an area where we've got Micron Technology putting in $15 billion and many other ancillary industries for Micron coming in, I think we're going to have a really good year here. And I think it's a great time to buy early. I think you will get into some competition if you wait until the spring, summer. So that's kind of my prediction for 2026. So Scott also, I'm going to show this there. Oh, there we go. Says, give us another example of creative financing option you did for somebody who thought they couldn't get a loan. So let's say you're self-employed and you have a really, really good accountant, but you have been really smart about having money aside for retirement. So you have a really good portfolio of stocks, bonds, equities, those sorts of things. We can take and instead of using your normal income that you do as a self-employed person, we can take and do what's called an asset depletion loan. We can take your assets and take them over about a 60-month period, and then we can show that as your income without you ever having to draw anything out of those assets. So you have no tax liability. You don't have to pull things out of any of your 401ks, any of those things where you get a penalty, but we still get to count those as assets and help you qualify for a loan, even though your self-employment income doesn't show as much as you actually make because you have a really good accountant and you write off a ton. That's just one example. Bank statement loans. Again, if you're self-employed and you don't like paying taxes, but you have really good cash flow, we can take 12 months of bank statements. We take the amount of your deposits into those business bank statements, and then we take what's called an expense factor, usually between, let's call it 65 and 70% of your deposits we can use as income, because we're going to take a 25 to 35% expense factor for most businesses. And that's another great way to help people who don't show great income on paper into a home. Obviously, you're going to need a little bit of a down payment there, but most of those people that are in that position, that's not their issue. Their issue is just qualifying. Does anybody else have anything that they're curious about or would love some advice on? Or, you know what, who would you love to see on some of the Let's Get Jeffed Up episodes coming forward that maybe I can reach out to some people? I know I already have plans. I'm going to get the new mayor, Rick Hogaboam, on and have him on an episode of Let's Get Jeffed Up. I probably would love to reach out and try and get one of the builders. I don't think I could probably get Corey, but maybe a smaller builder, and have them talk about what's going on in the building community. But what are some things that you, the viewers, would love to see? Thanks, Scott. I appreciate that, bud. Anybody have anything they can think of that they would like to see, whether it's a local business, politicians? I've thought about reaching out to the Canyon County Sheriff, Karen Donahue, and see if I can get him on and talk about what's going on in our community as far as crime and where crime stats are, and what we're doing to make sure that we live in a safe community. I thought that would be an idea that I might do. Anybody else? All right, y'all. Well, I love everybody. I love doing this live. I'm going to continue to do this. And like I said, I'm going to try and have some really good guests this year. if you have any questions I haven't answered today, you can always shoot me a DM on Facebook, or you can text me 208-371-1508. Hope everybody's going to have a great 2026, and we'll see you next week.